Right, hello everyone. Welcome to this. Welcome to this edition of the podcast. Ralph's just said something very highly inappropriate, but hopefully I've edited it out.
Wasn't inappropriate. It was
So
just amusing.
yeah, it
Can
was.
I just
Yeah,
the new thing is that I
yeah,
try to make Peter laugh just before we go
yeah,
live.
yeah. No, and
Yeah.
it works, and that did work. So okay, we're going to be talking about two things today. One, we're going to be talking about Trump's big beautiful bill. And then the other thing is we are going to talk about virtual research analysts at UBS. Now, I have actually spoken a bit about this in an earlier podcast this week, but because Ralph was an actual real life research analyst, I thought I'd be highly remiss of me not to ask him what he thought of this. So anyway, let's start off with the big beautiful bill that went through Congress with a massive one vote that went through, and now obviously that smooths the path. It's got to go to the Senate, but what are your thoughts on this Trump bill?
Well, when you look at the commentators on this, some of them highlight that this bill could actually be having unintended consequences for the bond markets and commensurately for the very status of the United States as a reliable credit risk. And beyond that, therefore, some people see the risk now shaping up that the United States might default on its national debt, ushering in what some people see as a potential financial crisis.
Mm-hmm.
And the word financial crisis, of course, now puts scares the heebie-jeebies out of everybody after we had two global financial crises and everybody went basically bankrupt. So I just wanted to talk about that commentary a little bit and put it into perspective, because it is, of course, easy to dramatize, but also I don't think we should trivialize. This is, I think, a risk which is real, albeit I cannot myself judge whether the extent of the risk that is being highlighted as a potential global financial crisis is justified. So that I don't know. So I just wanted to talk to that a little bit. And but starting with, indeed, the majority here. I mean, the majority wasn't large, was it? It was one person, and in fact, we have 220 Republicans in the House and 212, I believe, Democrats in the House. And there were two dissenting voices from the Republican Party. Two representatives voted against the Republicans, and then 3 abstained, and that is how you get to this situation. So the 212 Democrats plus the 2 which were coming over from the Republicans.
Can I just say,
basically.
At this moment in time, you've got to be a very brave,
yes,
and confident of your personal security,
exactly,
to actually vote, against your party at this stage. I mean, that's pretty. I mean, did you hear what Caroline? Sorry, I shouldn't be saying it, but Caroline Levitt.
yes,
she was pretty nasty in the aftermath.
Yeah.
I mean, she was pretty nasty about it, and you think, well, I don't know. You sort of think, well, look, it's supposed to be a democracy. If you don't agree with something, you're supposed to be able to vote against it. That's the whole point of it all. But anyway, sorry, I've got to really bite my tongue here. So anyway,
this is fine. I mean, we've highlighted the risk before the Trump administration, and now the reality of it, that America is being turned into an autocracy often enough. I believe this is not something which I wish to highlight now, but just because you said it, I believe the signs are everywhere. I just remind everybody that the leader of the executive in the United States is governing currently without parliament. And a pause here for effect. Doom music cueing. Because joking aside, that is a completely unprecedented and intolerable situation in a democracy, that in this case, President of the United States governs without parliament. This is the same as if Starmer would basically just do whatever he wants and bypass parliament entirely. Anyway, back to the situation here. So we have therefore 215 yays and 214 nays, as they do it in Congress, and therefore we have just passed this with one individual majority. To your point, just briefly, indeed, one has to have courage of conviction these days in America to go against the Republican Party, in particular because these votes are not anonymous. We know who they were. This is I think this is the representatives from Kentucky and the representatives from Ohio. Those were the two dissenting voices. So this is not like the Merz situation in Germany, where you have like 5 petty people from the CDU, basically just throwing a spanner in the works because they knew full well that it was anonymous and it can never be found out. This is out there in the open. So Trump is probably going to prepare a Christmas card for these two guys as we speak. So I'm not going to talk hugely about the actual stipulations in the bill, but we know roughly what they are. And what it is roughly we see that there are further tax breaks for the wealthy. There is importantly an extension of the 2017 tax cut. This is important to get right. I mean, this is not a further tax cut. This is an extension of the existing 2017 tax cut, which would have expired this year. Now it doesn't expire with the passing, well, it hasn't passed yet to the two houses, but if this bill is being passed, then these tax cuts are going to be extended. So the cost to the economy, which we are discussing here, is an opportunity cost. It is the cost that the tax dollars not collected if the bill, the 2017 bill, would expire in this year, as it was originally enshrined in the bill when that was passed in 2017. So that's the opportunity cost, and that's the biggest chunk we're talking about. And the opportunity cost and the cost of the additional, such as they are, tax cuts for the wealthiest in America are going to be partially funded by cuts in Medicare. So you have the situation that there is additional borrowing requirement to fund the net cost to the economy from this bill. But the US is already at the top of its debt threshold. You cannot actually borrow anymore. And that is why the bill also has a stipulation to increase that ceiling by $4 trillion. And the cost is estimated to be $3.8 trillion. So, don't have to be a mathematician to see that these two numbers correspond. And so that is basically what was being done here. If I wanted to be overly simplistic, you could basically say that tax cuts predominantly for the wealthy were funded by a reduction in benefits for the poorest in America, funded by fresh borrowing made possible by a lifting of the debt ceiling
changing
by
the
$4
rules.
trillion.
Yeah.
Well, yeah, but I don't want to be too dismissive of that. Everybody does that. I mean, that's
Yeah.
just normal. Germany has done it
Mhm.
recently. The UK has done it. I mean, so
We're
that
probably
in
going to have to do it
itself.
again, aren't we? Going to do
Well,
it again.
exactly. I mean,
Yeah.
that in itself is not really a source of my criticism here.
Mm.
Actually, I don't really even want to criticize it. I just want to critique the bill.
Yeah.
I don't want to go into this weighing of social equanimity
Mhm.
more than I have already done.
Mhm.
So that's what the bill says. But now the issue of that, of course, is that the US has, in the last 20 to 30 years, increasingly funded its balance of trade deficit, its growing balance of trade deficit, through the issuance of debt, through the issuance of treasuries. So to some extent, you could say that the business model of the US in the last 20 years has basically been to fund domestic consumption through debt. If the US was a person, then basically you just go to the bank, get out a consumer loan and buy a car. That's kind of what the US has done. And that is the reason why I'm now pretending I'm an American citizen, why we are in this mess in the US. The national debt is currently something like $36 trillion on a GDP of something like $28 trillion. And that is a very high percentage. It's higher than 100%, sure, but it's 130% or something, and that is a very high percentage indeed. Now we need to sort of look at the cost of that debt, because clearly every year the borrowers, in this case the US, has to pay the lenders some coupon rate, which you have to pay every year. And on average, I have calculated this with extreme accuracy. On average, that's not actually sounding that high. On average, it's a 2.6% coupon rate. So 2 points here. It is a 2.6% coupon rate, and that in itself doesn't sound very high. However, in terms of absolute cost of debt, given that there is so much of it, 36 trillion, this still equates to 3.4% of GDP. And that is a high number, especially if you compare that spending with one other benchmark, and that benchmark is the defense spend of the US in a given year, because that is 3.2% in 2025. In 2023, I think it was, but that's round about the same time span here. So we're looking at, I mean, now I'm rounding, but we're looking at proportionately the same amount of money goes into just servicing the national debt as goes into investing in the United States military. And I said last time on the show that there is a economist by the name of Adam Ferguson who has looked at this dynamic 150 years ago in a paper, and he basically claimed that when these two metrics come into equilibrium, and worse, when there is less defense spending proportionately than a country needs to generate in order to pay for its national debt, it is at that point that empires start to fade away. And I said last time on the show that I'm pretty sure that the Trump administration is either aware of this or that it certainly wishes to avoid this. This is why the Trump administration is trying to get to the bottom of the situation by, I believe, urging the Federal Reserve Bank to lower interest rates. But the Federal Reserve Bank is not following suit because it is independent and it has not yet done this. So now let's go with that and look at the bill and see what that might do if we project it out. Because the bill says, well, it's not the bill says, it's the OBR equivalent in America, the Office of Budget Responsibility equivalent in the United States, estimates that as a consequence of this bill, over the next 10 years, $3.8 trillion, $4 trillion in fresh debt is going to be added to the national deficit. And now let's look at two other things. First is Moody's and Standard & Poor's. All the rating agencies have reduced the credit rating of the United States. It used to be AAA, the gold standard, the best rating which you can have. Now it is a notch less. So the United States has lost its stellar credit rating, and when that happens, the cost of debt increases because to an investor, the perceived credit risk has increased. So that's point number one. Credit rating has been lowered. As a consequence, interest cost is going up. Second point, the tariffs, the way they're implemented, the volatility and erratic way in which they are sometimes on, sometimes off, has created a situation where it is reasonable to expect at some point in the future the dollar to lose, certainly dilute, its status as a reserve currency. That sounds like it is a theoretical thing, but it's actually very real, because the fact that the US dollar is the haven, the safe haven currency, the reserve currency in the world, has meant that the United States was able and still is able to issue debt at favorite prices. So the 2.6% average cost of debt, which I have referenced here, would be higher if the US dollar lost its status as reserve currency. Economists estimate that the discount here could be as high as 100 bips, 100 basis points, that's 1 percentage point. Sorry, I am full of jargon. I can't get the city jargon out of my head. That means, that simply means that if the dollar did not have status as reserve currency, that 2.6% average might be as high as 3.6% average. So we have credit rating reduced, cost of interest up, reserve status potentially in danger, cost of interest up again. On top of that, 4 trillion new borrowing over the next 10 years. And no prizes for guessing, you see where this is going. If you put all of this together, then in 2035, it is estimated, I looked at some estimates and I calculated these numbers myself, that the cost of the national debt in percent of GDP in the year 2035, as projected by economists, which I have looked at for sources, and as calculated by me, would be approximately 4 to 4.3%. As compared with that other metric, defense spending in percent of GDP, by 2035 would be about 3.5%. So currently in 2025, the two metrics are even. They are about to cross over. In 2035, materially as a consequence of the big, beautiful bill, the metrics have crossed over and we are spending more on our annual servicing of the national debt than we are investing in the military. And according to Adam Ferguson, 150 years ago, that is the time when empires fall. Now, I'm not going to be doom-mongering here. I'm not going to say, you see, Adam Ferguson said this 150 years ago, therefore the US is toast. But I would like to offer this analysis, these projections, and these thoughts to highlight a risk that is shaping up here. And the risk is that the United States is going to lose its status as the leader of the free world, the premier economy and military in the world. And the bond markets are already telling you that this risk is perceived to be real by investors. Because when this risk is shaping up, what investors are doing, they are selling the bonds. They are selling the national debt of the United States. And when you sell a bond, the yield goes up. And that is what the numbers show. The 10-year the yield on the 10-year treasury has increased, means that people are selling the treasury in the background, and they're selling it because they are concerned that the national debt of the United States might lose its haven status. And there we are. So that's the oh, and by the way, the big beautiful bill, if you acronym that, you get triple B, BBB, which to those who are not in the know is the worst credit rating you can still have while you are regarded as investment grade. The next one down is basically non-investment grade, which means that the next one down is when investors would perceive you to be such a poor credit risk that they demand a huge premium. So yeah, it just occurred to me. So this is the triple B bill, basically.
Oh, that's very good. I like that. That's very good. Right. So let's shift gears and talk about something I found fascinating this week. And this all came from an article from probably from the FT about UBS and them doing using AI versions or AI generated versions of their analysts. Now, I mean, I'll just say that just to explain to people that in basic terms, in an investment bank, there are lots of research analysts. These research analysts cover different sectors, and they have very, very deep knowledge. And their job is to have deep understanding of their sector, but to usually generate reports which will guide investors in their decisions. And those reports will be based on financial models, will be based on the analyst's interaction with the company, and they tend to interact with all the top people, chairman, CEO, CFO, and then other people that might talk. So the idea is they really know what they're talking about, present company accepted, of course. And anyway, but I mean, in reality, we all know that they just like sit around, do the odd spreadsheet and
putting our thumbs.
Yeah, that's right. Really
getting the beers up.
Yeah, I was going to say they get really good at drinking champagne, and in all sorts of scenarios. But no, I mean that's basically what you do, and your job, the analyst's job is to have this amazing a well of information, and then dish it out to clients in the way that the clients want. Now that's that sounds bad, but it's about, so if you've got it, you have this well of knowledge, but you're going to advise different clients differently depending on what their horizons are. What their horizons are, what their investment style is, and all that kind of thing. This is what I always said to people. I mean, what I used to do is essentially regurgitate the gems of information that you deemed okay for us to do.
That fell off my table.
That's right, yeah. And just taking these crumbs like a little kind of golem,
all right,
like a little golem,
violins,
my precious. It's also anyway. So even then, so you advise, say, a hedge fund manager that has, let's say, a 2-day time horizon, investment horizon, to someone who runs a pension fund and has a 5-year investment horizon.
Yes.
You have the same information, but you are trying to present what the relevant information in the right way to that person so that it rings true with them, right? So that's essentially what it what it entails. And so it seems that UBS has decided to sort of tap into this whole thing where people are generally consuming things via video, and they like consuming things via video. And rather than have the analysts running around even more than they used to anyway, they would decide to maybe input a load of that analyst generated information into a model, do an avatar of the analyst, and then send that to people. Now, I imagine certainly for the short term, I would imagine for the next, for the short term, certainly for the next year or so, I bet you that'll be really, everyone, if they're not already doing it, they'll probably be doing it, because I imagine that, it's probably quite popular. So given that you were, in that position, I mean, what do you think? Do you think that AI could ultimately, replace analysts? I mean, how do you think it works?
Yeah. Let me maybe not answer that exact question, but a modified version of it. And by the way, that's how I used to do my job. When I got a question that I couldn't answer, I would just change the question.
So, good question. Anyway, I'm going to just talk about this.
Yes, exactly. Yeah. Well, you want to know what AXA is doing from here? Good question. Well, Allianz, for those not in the know, these are two insurance companies, but they are completely different. Anyway, your question was, could AI replace equity analysts at some point? I'm going to talk to that as well, but maybe not right now.
Okay, fine.
Because
next week?
No, perhaps. If I wake up by then.
Okay.
Because the product here at hand is on a lower scale than that.
Right.
This product is not meant to replace the analyst completely. It is meant to facilitate the production of one particular product, helping the analyst to communicate their findings and recommendations with the client. So let me just step back and summarize also what an analyst does, sort of commenting on your excellent analysis there. Because what you said is exactly right. The way I would say it from my point of view is that the analyst takes a look at the analyst's job ultimately is to give commercially relevant, actionable advice to the fund manager. What to buy and what to sell. The fund manager, of course, being a professional fund manager, is the ultimate decider here. They decide what they want to buy and sell. They have their own analysis, they have their in-house analysts, and they have all the external analysts who work at all the various investment banks, and one of them is me, or you used to be me. So I would now, in execution of my mandate, look for commercial opportunities. I would, for example, think one company here is trading below its value, and that is generated by an exaggerated fear of the investment community that they might have a reserve increase or something. I would then try to analyze the risk here, and in order to analyze the risk, I would look at disclosed financial information, the whole gamut of what you now said. Disclosed financial information, disclosed company presentations. I would have access to the management of the company, to the extent everybody else in the analytical community has, not more, but also no less. So I have this access. And I would then put this all together, perhaps come up with the conclusion there is an exaggerated fear of a reserve increase. My analysis shows it is unlikely for the company to have a reserve increase. Therefore, there is an opportunity to buy this company now and profit from the share price increase, as it will become clear that they are not going to have a reserve increase. I put all this into a note, as it is called, which is a research report, a written report, and that report is then sent out to all of our clients. So just to not correct, but clarify one of your comments. You said the analyst advises clients in a different way according to what the client's investment horizon is. That is true and it's not true. I will always have the same recommendation to everybody.
Right,
if I say I need to buy this company for the reasons that I have just highlighted, then it is a buy recommendation, and that buy recommendation is, first of all, the recommendation to which I, as the analyst, commit my company to. Nobody can do something else. The sales force cannot then go to the client and say, our analyst says buy, but he's a bit of an idiot, and I say sell. That's not possible. The sales force is not compliant to do that. And I, of course, can't say to a hedge fund manager, buy this now, it's going to be cool, it's going to be rocking up in 1 week's time. And to the pension fund manager say, I would sell it because in a year's time it's going to be down. That's not possible. So it's the same recommendation to everybody, disseminated to everybody at the same time. That's the absolute rule. I mean, this has been drilled into me, and this cannot be different. This is the compliance rule of the SEC in America and of our various regulation companies here in the UK, and that's how it goes. However, where you are, of course, correct is the next bit, and this is more subtle, because the research note, the report which I have just written, is being disseminated in this way to our clients, but then it is followed up by various ways of client contact. I, as the analyst, would be on the phone and I would say, you see my research report, my reasoning is this. The sales force will be on the phone and say, our analysts just put a buy on Munich Re, and this is the reasoning, and it's going to be cool, and you've got to be in it, and all this kind of stuff which salespeople say, you know.
Hey, you want to go to the pub? No, I wouldn't say that. No.
It's the last train in town, and you've got to be on it. And the traders would be on the phone, and they would probably say things like, fill your boots. And
cheap as chips, fill your boots.
Exactly.
Yeah.
And so that's the sort of thing. And also, the research note is just one product. There are other ways to communicate with clients. One is on the phone, and now it comes. But there are other things. And investment banks, and my shop, where I was for 14 years, has also tried to develop what I would call an ecosystem of products which are addressing clients in different ways. And this is to your comments. To sell the notes to the client how they want to be sold to. The hedge fund manager has a concentration span like a gnat and has 5 minutes to read the note. In 5 minutes, they are going to get through the first paragraph of the executive summary and no more. And what they also may have time for is to watch a video. And this is where we are now. because this is the mainstay of this AI, that video. But before I get to the AI, let me explain how that video might work. Because at my longest job, what we had is the idea to create these videos.
Yeah.
We had
So, hold on. I've just got to say, for people that don't know the lingo, right?
What's that?
Ralph did not work in a shop. So he didn't work in a shop. When we talk about things like this, like where we worked, the companies we worked, for some reason, we always say, what shop are you at? Or where I worked at this shop, right? So what we actually mean is an investment bank. Right? That's what we actually mean. So sorry, I just thought I'd just say that in case people came into this and go, what? I didn't realise he worked in a shop. But anyway, carry on. Sorry.
Yeah, I sold my research notes over the counter.
Yeah.
No, shop. Yeah, weirdly enough, it's a firm, an investment bank, a company, or a partnership, or whatever it might be, broker house in my case. And that particular, but I'm going to use the lingo now so that you guys
okay.
we'll let you into our world. It's all good, and so. The shop where I was at the longest, we developed an ecosystem of products. One was clearly the research note, then the direct phone calls, of course, and the personal meetings with people, with the fund managers, and also importantly podcasts and videos. So we already had that idea to develop what today would be an Instagram short or a TikTok short at the time, something that condenses the essence of the broker note, the research report, into a easily digestible but nevertheless not too cooked down format. You don't want to be superficial. You want to, you're smiling. You don't want to be superficial, I tell you. And you want to deliver all of this stuff in a format which can be digested easily, so that you do not have to read the entire broker note if you haven't got the time or if you haven't got the inclination. Now, that video, this would work like this. First, you liaise with IT. So the IT dude has to come down and put up a camera somewhere. Where would that be? In a conference room. That has to be booked. So your desk secretary, you liaise with your desk secretary. When can I have the conference room? And that has to fit in with your diary as well. So then the dude comes down, the camera is in the conference room, you're there. You have to think about your note and condense this into a script, which is non-trivial, but still produces the essence of the commercial actionable advice, which you are talking about in the note, and the reason why you're giving it. So you script yourself. When you walk up to the conference room, you sit yourself down and you look into the camera, and not quite into the camera, but a little bit at an angle, because otherwise it's too much. So you need to receive some sort of training of how to do this. Then you need to slip into like an acting mode, because you're like a newscaster. I mean, you can't be too wooden there and too weird. And so and then you do it, and you better do it right, because there is no auto cue. So you have to know your text, and so you have to do all this, and then you deliver it, and then you're done. So that might well take up to half a day. It will feel like it takes half a day, and it involves not just you, but equipment and the IT department and your desk secretary and yourself. So there is a high cost to developing such a video. And now I'm finally at the point, because we're talking about an AI in the case of the UBS AI project here, taking over almost the entirety of this effort, because the AI will look at your research report, summarize it. You still write the prompt. We all know how LLMs work, so you need to train yourself to write the prompt in a way that allows the AI to take out the salient commercial points of your note. Write yourself a script where the AI writes the script for you. and it then delivers it as you, because you are the avatar. There will be a simulacrum, a hologram of you talking, but it is not you. But it will be talking with your voice, because your voice is cloned, and it will be lifelike. And if all of that is technologically seamlessly done and has bedded down in the company like UBS in this particular case, then you get to the point where indeed you can put out your broker report and it will just be part of the routine. You put out the broker report and you go about your business, but before you go to the conference, for example, to talk about before you go to the company meeting where they present the numbers, what you do also is you quickly liaise with somebody to get that video done, and it no longer involves you sitting in front of a camera or whatever. You are on file as the avatar. All that needs to be done is to produce the video by the AI. I haven't seen this product. I'm guessing this might take 10-15 minutes rather than half a day. And then you still would need to actually look through it and sign off on it, because the human analyst still has to see whether the AI has accurately reflected what's in the broker report, and it then still has to be compliant and edited. So that's just the sort of various stages through which a note has to go. Everything which basically passes passes the threshold of an investment bank has to go through these hoops. But so in the end, I think that is what we're doing here. So coming back to your original question, I think if this is done well, it would be a huge help to the development of an ecosystem of products that talk to an investor in a time-efficient way, where the investor can consume a quick video which is delivered by an AI synthetic analyst. The investor will not think it's you talking. It will be clear that this is an AI, because it would say AI generated, and take away quickly the salient points of this. Another product done within 10-15 minutes, which normally would have taken you half a day to produce. And that, I think, may well be the future, but I have some more thoughts on this. But that may well be the future. So I like the idea, I have to say.
I just one of the reasons why I was smiling is because when you were talking about that, I was thinking, I wonder if this is going. So first of all, it's very interesting what you're saying about the products, the suite of products. Basically, you're trying to create a number of touch points between yourself and the client, so that when it comes to which broker do we think is best, or who do we think is best, then you're thinking, well, I've seen the video, heard the podcast, done this, read the note, didn't you think, well, yeah, it's them. They're the ones that I go to. But my thing is, I just think it would be really funny if it turned into a sort of like a TikTok / shorts thing, where at the end they go, I don't know if you've ever, you might not have heard of him.
No,
but
that's what it would be.
There's this Irish guy called Garen, right? And he does he's really funny. And at the end he goes, "Follow me, I'm delicious," like that. He does that at the end. You think, if you were an analyst, you had like a brilliant thing at the end, like, "Follow me. 60% of the time I'm right," or something like that. Or 60,
I love it.
Was it Ron Burgundy? Yeah, so 60% of the time I'm right every time. You could do something like that. It'd be brilliant, and it would go round everywhere. It'd be fantastic. But anyway, yes. I think
I think that might be possible. It depends on the style of the house you're working for. But when I was at a different shop, there were quite colorful characters. One person would sing his contribution to the morning meeting just to be differentiated from all the other geezers.
Nice.
And I have to say, anyway, yeah, carry on.
I have actually on occasion sung to clients myself on the phone. Only briefly.
Yeah, don't do this now.
And only to people that I really knew well, right? So I wouldn't do that to everyone. But anyway, Yeah, I think it's very interesting. Lots of touch points. Nice. People are used to this kind of format, and if you do a good job, it could be very interesting. It does look a bit freaky. It can look a bit freaky. I mean, there's someone I know, for instance, who I've seen using Synthesia. So used, sort of uploaded themselves, or with Synthesia, and it's interesting because usually their real life self is very lively, and really friendly and bubbly and all that sort of stuff. Doesn't quite capture it on Synthesia. Seems to be very serious, and you think, in a way, it's a bit of a shame because it does not capture that energy really. But I think that as a time saving, useful way to be able to provide an easily digestible, potentially viral,
entirely.
touch point.
Viral it can't be. Remember what we're doing here. We are communicating with our clients, and our clients only. We are not compliant to put this out into the wider sphere. These things are not going to be on TikTok, Instagram, or Facebook. These things are going to be in the inbox of our clients, and there they will remain. And possibly they will fester there.
fester, wither, and die.
Exactly. No, but this is a different proposition. It is like a TikTok video or an Instagram short. But you see, here's the other thing which I was thinking about. This, I think, could potentially be very interesting, because this goes back to your point. And your point was that no client is like the next client. Every client has different needs that are specific to them and not to others. If I'm a hedge fund manager, I'm interested in short-term outperformance, and I don't want to hear or read long elaborations of Ralphie, the technical mathematician or something. If I am a specialist, quant perhaps even, then I might very well engage with Ralphie on this aspect of insurance because I can, and I'm interested in doing it. If I am a long-only pension fund manager, then I will have a very long-term investment horizon, up to 5 years. And I have the time to engage with Ralph, but I do not have the technical depth to do so because I have other sectors, not just insurance. I look at retail and maybe oil extraction or something as well as my mandate. So I only mentioned 3 people now, but you see you have 3 completely different reception environments. Now when I write my report, it's only one report, and it basically or arguably has to service everybody. I have to be technically accurate and hopefully insightful to talk to the specialist. I have to be commercially relevant, but not too esoteric to talk to the long-term generalists. I have to be commercially actionable to talk to the hedge fund manager. I have one note, not many. So one note has to service them all. And the way in which this is done normally is to have this sort of layered system. You have a title page which summarizes the title page that has a first paragraph. That's the executive summary, the distillate of all of this. This is the condensed as it gets. Then if you have more time, you read the first page, the title page, then you read the executive summary, and then if you wish, you read the entire note. Arguably the video, because it is being produced by an AI, can do all of this. I can earmark in my client database those clients who are, for example, hedge fund managers, and those clients who are, for example, 5-year horizon pension fund managers. Depending on who is ticked, the AI will assume a different persona.
Ooh, I like this.
It will assume the persona of Ralph, the financial mathematician, when the video is sent to a quant. It will assume the persona of Ralph, the short-term, sleeves rolled up commercial guy, when it goes to the hedge fund manager, etc., etc., etc. Second point, it will have the ability to talk to the fund manager in their native language if that fund manager chooses to be talked to in their native language. I can speak Spanish, Chinese, any language I want in an avatar. And we have seen this already. This is no longer science fiction. This goes very well. It's lip-synced to perfection. There is no issue. One cost to produce one video, which potentially generates a range or suite of custom-made short-term touch points. That is the power of this product.
Ooh.
And that I have not, funnily enough, seen in the write-up of UBS or anywhere. So either UBS, if you're listening, I'm receiving commission for my excellent advice. But what I am actually thinking is that they haven't actually talked about this in the press. They're not stupid. They probably will do this. If they don't do it, that's how this should be used.
I think that is genius. That's the thing, isn't it? I suppose you are writing as the expert, the almost like the master,
exactly.
the master document. And then all you do is you then say, you make up avatar. When you're doing prompts, you have like an avatar, you'll say, okay, write the summary in 200 words of this note, in bearing in mind that the person receiving this note works at a hedge fund. Their investment horizon is 2 days. They are they're interested in short-term recommendation only.
Yeah.
Hit.
And then exactly. And you know how this works. I mean, we've used ChatGPT and all the other LLMs which are out there. You can tell them, assume in the prompt, assume the persona of a scientist. Or you can say, assume the persona of a journalist. And you will get different answers. So here you would say, assume the persona of an analyst who talks to hedge fund managers. This has to be trained. This is not going to fall from the heavens. But the AI has to be trained in this way, but that's an acquisition cost. Once it has been trained in this way, you can always assume this persona, given that your research, by the way, is always written by you, and therefore will follow the same sort of idiosyncratic grammatical structures, the same idiosyncratic morphological usage. This is basically the style of Ralph. This is not style I have developed consciously, it's just because I'm me. And you would write something differently. So the AI would always know who is writing the particular product because of these various linguistical idiosyncrasies, helping it to mark the author of this and map that with the various personalities to map themselves to the client. That's how it needs to work.
I think this is genius. I do. I mean, the thing is, though, right, you could create these avatars of the client and you could apply them to every single sector. So when you're the analyst of, say, the retail sector, you're thinking, right, I've got to send, a version of my note, to my hedge fund clients, and then you look through like a directory of avatars. And then when you just cut paste, say you ChatGPT or something and say, right, interpret my this note for and then cut and paste in that avatar.
Well, this will be automatic. This will be automatic. I mean, this is when you finish your note and you send it to compliance. and it is ready to go, then automatically all this suite of videos has been produced by the AI already. It still has to go to the analyst to check, and this is I don't know how that needs to be done, because it would be counterproductive for the analyst to check every single video. But that's an operational matter, and this can be solved. But what I'm also now wanting to say is, now I'm ready to answer your question. Because your original question was, is AI going to be able to replace the analyst? And I would say that if, as everybody who is in the profession, you are tending to be defensive about this. Because my first answer is, oh, of course not. This is completely ridiculous. I mean, the analyst is completely complicated cognitive situation here, and AI will never be able to do it. Well, I'm not going to say that, because I don't know what the capabilities of AI are at the moment, and I certainly don't know where they're going to be in 5 years' time. What, however, I would say is that at the moment, I would be very skeptical indeed whether an AI could replace an analyst. But this type of instrumental help that the AI could deliver, that is a reality, and that is a sensible product proposition which I think every stockbroker and investment bank should pursue. And the reason that I am currently still skeptical of whether an AI could replace an analyst is partly rooted in the fact that I used to be an analyst, and I therefore know what it entails to be an analyst. It is not the analysis is almost like the least part of it. What you need to be able to do is spot the commercial opportunity, first of all, then write it up, disseminate it. That's easy, that's just operational. But you need to understand the business model of your company, the company you are following, as it dynamically evolves. And you can only do that if you're constantly in touch with management, and you talk to management, and you listen to what they want you to hear, and they also you need to listen to the subtext of what they are saying. And then you need to take all of this often intangible information and build it into your company model. Because a model of a company for an analyst, that's not just simply an electronic version of the balance sheet. Sure, everybody needs to know accountancy to the point that they know how it all interlinks. But the real benefit of a advanced company model generated by a professional analyst is that the model replicates the business model of the actual company. That it allows you to, a company is a breathing organism. Everything is connected. More debt, less return on equity, higher beta, everything is connected. And this, your model needs to be able to reflect. Now, I am not saying that AIs won't be able to do this, but what I'm saying is that currently it is the very nature of an analyst's job to feel out some of this information and then translate it into quantifiable mathematical modeling that makes out the professional quality of an analyst. And from what I have seen that AIs are capable of doing at the moment, I'm at the same time amazed what they can do, but I still think this falls far short of what a human being, an advanced professional, not just as an analyst, but in other avenues as well, is currently able to do.
I mean, I think this is the thing. I mean, obviously, we're talking about research analyst investment in an investment banking scenario, but
Sure.
I do think that actually this is something that could be used for so many things, and actually, you'd have fewer restrictions because like you were saying, these videos only go to your clients. Whereas actually, if you're a business and you're wanting to get exposure and you're looking, to cast the net wide,
Absolutely.
you really could go to town and try to go viral with something like this. I mean, the interesting thing here for me, from what you've just said, is like, it's almost like you're receiving like a personalized type video.
Yeah,
and then
exactly.
You think, that's interesting. I must talk to them to ask them more about this.
Exactly.
That's a really good, that's a really good introduction.
That's the video. That property of the video would be like a teaser.
Yeah.
And of course, to the extent that it's technical, you cannot condense technical material into a TikTok video.
Yeah.
But you don't have to. This is still very much useful. The analyst would then, the fund managing analyst would then get in touch with me, with the research analyst, and say, dude, I've seen the video, very interesting stuff. Can you tell me more about how you model this, how this works?
So, you've really hit on something.
No, this is very cool. Well, I just wanted to, I don't know, we can talk about this more, but from my point of view, I just have one more comment which I wanted to make just for completion, because I think you also, at the very first, you basically threw out the potential issue with who owns the information.
Yes, I was going to say that. Yeah.
I do wonder whether that's a problem. It may well be, and I'm not operationally, I don't really know, but it doesn't seem to be a problem to me, because as you said, the IP, the intellectual property of everything the analyst does is the intellectual property of the firm they're working for. And that's it. That's it, basta. The models which I do for the company are not my models. When you move, you're supposed to leave them behind. And of course, the idea there is that this puts you at a disadvantage, because these models have been years in the making. There's a lot of thought which goes into that. There's a lot of data which go into that. If you leave all that behind, then when you need your 6-month garden periods to actually replicate all these models, if you have 10 models to replicate. So that's that. All the notes which you've written are the property of the company. Everything you ever said is the property of that company. And so the avatar, your likeness, is the property of the company as well, but I would say that it is that specifically rendered version of you as it appears in that video. That's the property of the company, not a newly rendered version of you, which another company might do, even if it looked exactly the same. But also think about it commercially or practically. If you leave and you go to a different shop, well, your old shop is not going to use your avatar.
No.
In fact, that's the last thing they're going to do, because we all know this. I mean, you are a superstar while you're working for your company, but the second you're gone, the sales was gone, the firm says, he wasn't very good though. I mean, it's just rubbish. There's no loss to us. So that's the last thing they would do. So I don't believe there is going to be any issue with that part.
Well, I mean, there's so many more questions I'd like to ask, but we've got to stop here. But look, thank you very much. Really, really fascinating stuff. And I have to say, I feel that we will revisit this. I'd love to. It's a really interesting area. That it's not just about UBS and investment banking; it's everything. So yeah. But anyway.
So, by the way, before I go, I just wanted to say that for the last 40 minutes, I've been down the pool drinking pina coladas. This here is my inflatable Ralph AI simulacrum talking.
Nice.
This is why there are glitches.
That'll be it then. Yeah, good. Well, thank you for clearing that up, Ralph.
Oh, okay, cool.
Yeah, it's really really useful. Anyway, As always, thank you so much. It's been really, really interesting today, as always. But thanks
It was
very
my
much, Ralph.
pleasure, as always. Always
you.
love to be here.
Brilliant. And
Good
thanks
stuff.
everyone for listening, watching, whatever you're doing. Have a great day, etc. Anyway, thank you. Bye.
Thank you, guys. Thank you.
Bye.